How smart traders make money when they're wrong. What if I told you that the secret to consistent trading profits isn't about being right more often? Take a breath, because this is the trading blasphemy you need to hear. What if you could actually be wrong 60%, even 80% of the time, and still pull boatloads of money out of the market? Most traders are playing the market like it's a high-stakes guessing game. They chase perfect predictions, get frustrated when their crystal ball fogs up, and inevitably, they lose money. Today, we're going to fundamentally shift your perspective. We're not going to hand you some magical blinking indicator that promises a 99% win rate, because those don't exist, and anyone selling one is probably living under a bridge. Instead, we'll show you how to trade with the mindset of a casino, understand the math behind consistent profitability, and implement actionable strategies to make money even when your market prediction is spectacularly off the mark. This is about bulletproofing your mind and your capital. We'll cover mindset, ironclad risk rules, professional trade management, and how to build unshakable confidence. Stick around until the very end, because we'll also guide you on the specific, tactical steps to turn a guaranteed losing trade into a break-even, or even a small profit. Trust me, that's where the fun begins. Part 1. Why being right is a profit trap. Our natural, deeply ingrained human instinct is a desperate desire to be right. In trading, this isn't just a quirk, it's a financial death trap. This desire is what makes you hold on to a losing trade far longer than any sane person should. It sounds something like this in your head. Oh, the price is going against me, but this can't be happening. It will surely move back. Oh no, it's near my stop loss. But wait, my stop is near that resistance level. It has to bounce soon. Maybe I'll just remove my stop loss and wait for the bounce to cut my loss. Before you know it, you've turned a quick, manageable loss into a permanent residency for your capital. You are essentially arguing with the market. And let me tell you, the market is a terrible listener. It has zero interest in your analysis, your feelings, or your rent payment. The casino mindset. What smart traders do. Smart traders don't try to be right every single time. They can't, and they know it. That's why they don't get emotionally affected when they lose. Think of it this way. Does a casino manager panic every time a customer wins at the blackjack table? Absolutely not. They know the math. The edge is tilted in their favor, and over a large number of hands, they will win. Smart traders approach the market with this same beautiful, cold-blooded logic. They accept uncertainty. They look at the market from a neutral perspective and admit, my setup didn't work out. This emotional neutrality means they have a higher chance of making a good, rational decision, like turning a potential disaster into a small loss or a break-even trade. They understand their edge is statistical. They know their winning edge isn't a guarantee for this trade, but a probability that plays out reliably over a large series of trades. They are emotionally neutral to individual wins or losses because they understand the series of events is what leads to profit. They are masters of loss mitigation. They cut losses as soon as they realize the trade setup is invalid, or they simply stick to their pre-planned hard stop loss. This is the entire ballgame. When they lose small, often even smaller than their initial stop loss. And when they win big. That's the key. Why is this a big deal? Because even the greatest traders on earth can't predict the market 100% of the time. If someone told you their strategy has a 100% win rate, they are, politely speaking, a liar. If a person could truly predict the future of a global, multi-trillion-dollar market, do you think they'd be sitting here selling you a course? No, they'd be buying their next island. Part 2. The 5 Unshakable Truths of the Market. We are not gods. We simply make educated guesses based on historical data and tested strategies. But the market can and will behave however it pleases. Your job isn't to force it, it's to adapt. Internalize these 5 fundamental truths about the market to bulletproof your mind. Anything can happen. Seriously, you don't need to know what happens next. Your profitability depends on how you react to what happens, not on what you predicted. Your wins and losses are randomly distributed. Stop trying to predict the pattern. Do not, under any circumstances, think, I've had 4 losses in a row. My system usually only allows for 4 consecutive losses maximum, so I can safely sell my house and go all in on this 5th trade. That is a fast track to financial ruin. Hell no. An edge is a probability, not a guarantee. You might backtest your strategy and find it worked 10 out of 10 times in the past, but one day it will fail, even when every single condition is met. Why? Because the market has zero responsibility to care for your feelings or act in a way that pleases you. Every moment in the market is unique. History rhymes. It doesn't repeat perfectly. So your goal isn't to be a market guru or a godly fortune teller. It's to be a disciplined executor of your edge. Part 3. The Profit Math. How to win even when you're wrong more often. So we've established that chasing a high win rate is a rookie mistake. Although a high win rate is indeed favorable, it's only half the game. The other half is the math that separates the consistent earners from the guessers. The true secret to lasting trading wealth isn't a high winning percentage. It's this simple equation. Profitability equals, open parenthesis, average win times number of wins, close parenthesis, minus, open parenthesis, average loss times number of losses, close parenthesis. Listen closely, because this is where we turn losing trades into a superpower. The power of risk to reward, RR. The way smart traders control this equation is through something called the risk to reward ratio, or R:R. You must aim for a minimum R:R of 1 to 2. What does that mean in human terms? If you decide to risk $100 on a trade, that's your maximum potential loss. You must aim to make at least $200 in profit. The market has to pay you double for taking a seat at the table. If it won't, you don't trade. It's that simple. Certainly, some traders achieve consistent profitability with a risk-to-reward ratio of 1 to 1 or even lower, most often through scalping. However, this is not a strategy suitable for beginners. It is unrealistic to expect a novice trader to maintain a win rate exceeding 50%. Furthermore, a 50% win rate combined with a 1-to-1 risk-to-reward ratio does not result in a break-even scenario. This calculation fails to account for transactional costs, including broker commissions, withdrawal fees, bank fees, currency exchange rates, and errors. Therefore, for beginner traders, aim for a 1-to-2 risk-to-reward ratio or more. This approach will simplify your trading life and give you a much higher chance of making a living out of it. Now, let's return to the topic of the 1-to-2 risk-to-reward ratio. Scenario 1. The 50-50 trader at 1-to-2 R to R. Let's quickly revisit our example. You take 10 trades with that 1-to-2 RR, risking $100 to make $200. You get a 50% win rate. You were right exactly half the time. Your 5 wins make you $1,000. Your 5 losses cost you $500. You walk away with a $500 net profit. You were right only half the time and you still made money. Not bad for being average. Tolerating mistakes. The 1-to-3 advantage. Now here's where the math gets truly liberating. What if you hunted for slightly better setups and insisted on a 1-to-3 R:R? This means risking $100 to make $300. Watch how much more tolerance this gives you for being wrong. Scenario 2. The wrong more often winner at 1-to-3 R:R. Let's keep the total trades at 10, but this time you have a terrible, rotten 30% win rate. That means you were wrong a massive 70% of the time. Your friends are laughing at your predictions, but who cares? You have only 3 wins that each make $300. That's a total of $900 in gains. But you have 7 losses that each cost you $100. That's a total of $700 in losses. The final tally? $900 minus $700 equals $200 net profit. You were wrong 7 out of 10 times, and you still finished profitable. This is the difference between gambling and professional trading. The lesson is clear. You must hunt for those high-reward trades and settle for nothing less than a risk-to-reward ratio that favors you. However, you also need to be realistic. Don't fall into the trap of thinking you're going to catch a massive 1-to-5 or 1-to-10 trade every single day. The 1-to-2 and 1-to-3 trades are your bread and butter. Be disciplined enough to ignore the low-reward setups and patient enough to wait for the ones that offer this kind of mathematical advantage. Part 4. Ironclad Risk Management Rules. Your trading shield. We've covered the mindset and the math. Now let's talk about protection. Because in the market, defense is the absolute best offense. Your risk management rules are your trading shield. They protect you from yourself. Rule 1. Fixed position sizing. You must use a fixed, consistent amount of capital risk for every single trade. This is non-negotiable, especially for beginner traders who aren't yet consistently profitable. Why? Because new traders and, frankly, many veterans love to vary their risk based on what they call conviction. That's not conviction. That is pure, dangerous emotion. What happens? You feel really good about a trade, so you bet big. That turns out to be your worst entry, and you take an oversized loss. Then you're scared, so you bet small on your next trade, which turns out to be a massive winner, but you only banked a tiny profit. Fixed position sizing removes this emotional roller coaster. It allows your statistical edge to play out consistently, and it proves whether your strategy is profitable without the variable of human greed or fear. You're trying to learn and prove your edge, not get rich quick. Rule 2. Maximum 2% risk per trade. Your ultimate, absolute maximum risk on any single trade should be 2% of your total account balance. For beginners, we highly recommend you dial that down even further to 0.5% to 1% per trade. Capital preservation during drawdowns. The cost of over-leveraging. Let's talk about the magic, or rather the math, of risk management. If you strictly follow the maximum 2% risk rule per trade and hit a disastrous run of 10 consecutive losses, a scenario that, while tough, is absolutely possible, you've taken a manageable 20% drawdown. You can recover from that. But let's say you were foolish enough to risk a whopping 10% per trade and then hit the same 10-loss streak. Congratulations! With the compounding effect, you're now down roughly 65%. You haven't just taken a hit. You've practically nearly wiped out your account. Trying to claw back from a 65% loss requires a mind-bending 186% gain. That's not a trading strategy. That's just hoping for a trading miracle. The skip-a-meal strategy. Trading for your health and wealth. Instead of obsessing over complex percentages and spreadsheets, try risking a fixed amount, like $50 or $100. It keeps your head clear and your math simple. As a beginner, look for the sweet spot. Risk an amount that won't break your heart if it's lost, but will force you to stay disciplined once you're in the trade. The secret hack. Trade your lunch money. Here is a practical and slightly hilarious trick. Risk exactly what you were going to spend on dinner today. If the trade goes south, congratulations, you're fasting. Look at the bright side. Science says intermittent fasting is great for your brain and longevity. You're literally trading your losses for a six-pack. It's the only market move where a red day results in a health win. Pro tip: if skipping a meal sounds like a financial crisis rather than a diet choice, stay on a demo account. Your broker has minimum requirements anyway, so don't try to play big shot before you've mastered the basics. The marathon mindset. Trading is a slow burn, not a 100-meter dash. If your goal is to flip your account overnight, you aren't a trader. You're a gambler at a casino. That mindset is a one-way ticket to emotional burnout and a fiery blow-up of your bank account. Stop guessing your position size. Use this simple calculation to stay in the game. Example, the $10,000 safety play. If you decide to risk a safe 1% of your balance, your max pain is $100 per trade. Your position size is a calculated decision, not a desperate prayer. Rule 3. Trade management is everything. This rule is about execution. Let your winning trades run and cut your losing trades immediately. Cutting losses quickly. Your stop loss isn't a suggestion. It's a hard, immediate exit. As soon as the market proves your analysis is wrong and hits that line, you exit. There is no hoping it comes back, no maybe I'll move my stop. That violates the fundamental truth that anything can happen. Holding on to a loser is the most common reason why traders fail. Letting winners run. This is the flip side of the R2R equation. You've done the work. You've risked $1 to make $2 or $3. Now trust your system. Don't grab a tiny $50 profit out of fear, only to watch the trade rocket to your $300 target without you. If the price action looks healthy, let that winner run to its profit target or beyond. For advanced protection, you can use a trailing stop, a stop loss that moves up as your profit increases, to lock in gains without limiting the potential reward. This is how you bank those asymmetric gains that make your 30% win rate profitable. Part 5. Building unshakable confidence. Fighting fear and greed. We've talked about math and risk, but let's be honest. The moment the market moves against you, all that theory can fly right out the window. The million-dollar question is, how do you actually manage fear and greed? How do you make the right decision to cut a loss or let a winner run when your money is on the line? Many people will tell you to manage your fear and greed. They'll advise meditation, deep breathing, or walking away. And yes, being calm helps. It keeps you from rage trading your account into oblivion. But here's a critical realization. Being calm is not enough. Imagine you're in a trade. The price is moving against you toward your stop loss. You remind yourself to be calm, and you are. But you're still thinking, do I cut the loss now, or will it miraculously turn around? You're calm, but you are utterly confused. Confusion is the real enemy. It comes from uncertainty. You can't make a rational decision when you lack certainty about your setup. This is what separates traders who know their edge from traders who are just guessing. The answer: intensive backtesting. You cannot rely on hope or emotion to fight fear and greed. You must replace them with data-driven conviction. The only way to build the confidence to fight your internal demons is through intensive backtesting. This is how you gain a deep understanding of the chart and acquire solid experience backed by real historical data. What is backtesting? It's essentially simulating trades on historical data. You rewind the clock on a price chart and trade as if it were live, moving the chart forward bar by bar. You are the time traveler who gets to prove their theory works. Why backtesting is absolutely crucial. Backtesting is not just a homework assignment. It is your professional apprenticeship. It achieves 3 vital things. It proves your edge. You see firsthand that your strategy works over a large, statistically significant sample size. You learn your strategy has a 40% win rate, but you know that 1 to 2 R&R makes you money regardless. A loss, therefore, doesn't sting as much. It's not a mistake. It's simply a necessary part of the statistical distribution. It eliminates hope. You replace the emotional decision-making, the "I hope this turns around," with a cold, powerful belief. I know the data is what is backing me up, not my desire for money. This shift transforms you from a gambler into a professional. It develops pattern recognition. Intensive chart study makes you intimately familiar with how your strategy's valid setups look, and crucially, how the invalid ones look. The emotional shift. Backtesting isn't just about finding a strategy, it's about conditioning your mind. It transforms the nervous thought, "I hope this works," into the powerful affirmation, "I know this works," over a large sample. It might be a mind-numbingly boring process, but it is what you absolutely must do to gain confidence. Only when you have a solid idea of where the price would likely go do you know when to act decisively. You know the moment your setup is no longer valid, allowing you to cut your loss before the price even touches your stop loss, effectively reducing your risk. You know when the momentum is high, allowing you to hold for an even higher target or adjust your take profit to gain more. The data frees you from confusion. The certainty allows you to be calm and make the right, profitable decision every single time. Next up, we're going to show you the ultimate trick: the tactical steps to turn a losing trade into a break-even scenario. Don't go anywhere. Part 6. Advanced Concept: the Bounce Strategy. For experienced traders only. All right, now that you've mastered the discipline of cutting losses and letting winners run, we're going to peek behind the curtain at a strategy that allows experienced traders to profit even when their short-term timing is terrible. Major disclaimer: this next technique is not for beginners. If you haven't mastered the basics of risk management and chart reading, I need you to listen and file this away for later. Trying this now without solid risk rules will lead to you funding the retirement account of the trader on the opposite side of your trade much faster than necessary. You have been warned. Trading the pullback. Patience versus panic. The fundamental concept is this: price never moves in a straight line forever. It breathes, it pauses, and it has pullbacks. It must exhale before taking the next step. Let's say you identify a strong downtrend and correctly enter a sell position to follow the momentum. But as soon as you hit the button, the price immediately begins to pull back, and your position quickly moves into the negative. A beginner panics, thinking, "I was wrong, I must exit," and cuts the trade right before it was about to succeed. An experienced trader, however, operates differently. The power of market structure. If you have good knowledge of market structure, you let the trade run. Why? Because you know that as long as the price does not move past the previous major structural point, such as the last lower high on a downtrend, your core setup remains valid. You've simply been caught in the market's temporary exhale. You know exactly where your logical stop loss is placed. At the level where the market hitting it signifies your entire analysis is invalidated, not just where your ego hurts. The worst-case scenarios. In a worst-case scenario, where the market decides to fully reverse and your analysis was completely wrong, there's still a chance for salvage. The existing bearish momentum often retains enough power for one last struggle. The bears might push the price down one more time, often creating a higher low or a double bottom, giving you a valuable opportunity to exit at break-even, a small profit, or a minimal loss. This requires exceptional chart reading skills and confidence. You aren't just hoping for a bounce. You are trading a high-probability mean reversion setup based on experience. The critical role of position sizing. The risk size of this trade is no different from any other validated trade, which means your position sizing must be tiny. You must trade small enough so that even if the trade fully goes against you, the loss doesn't destabilize your overall account balance. This strategy is about minimizing the impact of a bad entry, not gambling on a prayer. The key remains: you are wrong. In the worst-case scenario, you lose. But with excellent trade management, you significantly increase your chances of exiting with a profit, break-even, or a small loss. These scenarios, where knowledge and experience actively reduce the damage from imperfect entries, are what define a great trader. A final warning on stop losses. The placing of your stop loss is extremely important. You must place your stop loss at the structural point where price reaching it invalidates your setup. Do not place it in a no man's land, simply because you don't know where to put it. If you don't know where to place your stop loss, it means you need to learn more about chart reading. Conclusion: the path to consistent profitability. So, let's wrap this up. The path to consistent profitability isn't about being a market psychic. It's about the math, managing your risk, and disciplined trade management. You must maintain strict risk per trade, ideally sticking to the golden range of 0.5% to 1% of your capital. And the secret to success? It's the most boring advice you'll ever hear. Cut your losses and cut them again. When your losses are consistently smaller than your winners, you'll naturally, and almost accidentally, become profitable. Yes, you can be profitable even when you're wrong more often than you're right. But let's not get too carried away. You certainly still have to score some goals, right? Or, as we say in the trading world, you still need a functional edge. You can't just miss every single shot and expect to win the World Cup. The ultimate, uncomfortable truth. The ultimate message is this: you need to backtest, learn your strategy inside and out, and prove that your system is profitable based on historical data. Until the data confirms it, your strategy is just a hope and a prayer with a chart open. And guess what? Hope is not a strategy. Trading is a skill, not a guess. Stop guessing and start executing. Your 3-point action plan. Start backtesting today. Stop watching videos and start proving your strategy actually works. Seriously, if your system can't prove itself in the past, it's not going to suddenly develop manners in the future. Review or start your trading journal. Calculate your actual win rates and your true average risk-to-reward ratio. Spoiler, it's probably lower than you think. Commit to these risk management rules, starting with your very next trade. If you found this video helpful, do me a favor. Smash that like button like it owes you money. Subscribe for more trading insights. And let me know in the comments, what's your biggest challenge in managing fear and greed? I'll see you in the next video.